Hi.
Hi. Hello, good evening. Thank you so much for
Good
honoring our
evening.
invitation today. We're really
Okay.
excited. We're excited to learn all we can tonight about investing in stocks because trust me, stocks is a very scary topic and a lot of us don't like to put our money there, but we've seen a lot of testimonials from people who have invested in good stocks and they've actually gotten good returns. So we're going to learn a lot
Yeah.
from you today. So now I'm not going to assume that everybody here knows me. So my name is Ifedayo Duronsinmi-Etti. I'm the founder of AGS Tribe. AGS Tribe is a platform that connects women to each other and to opportunities. So opportunities like grants, fellowships, scholarships, investment opportunities as well. And this is one of the sessions, this is one of the things that we do so that we can continue to empower women socio-economically. So with me today, I have someone from I Invest, the COO. I'm not going to say his name so that he will say his name by himself and he'll just tell you a little bit about himself and what we're going to learn, at the end of today. So Jide, you have the floor. How the session is going to go, we'll just discuss. I have a couple of questions that I'm going to ask him, and then at the end of the session, we'll take questions from the audience. I'm hoping that we can stick to an hour, but even though we don't stick to an hour, we can always come back, but we'll try to keep it within an hour. So now you have the floor. So please just introduce yourself, your name, what you do, and what you're really going to tell us. What you're going to talk to us about today.
All right. Thank you very much, Ife, for having me. As she rightly said, and has been put everywhere, my name is Babajide Lawani. I'm the Chief Operating Officer of Parthian Partners, the founders of I Invest. Essentially, I Invest is a platform that gives you access to an array of securities, treasury bills, Eurobonds, equities. We've included fixed deposits now. Essentially, just giving you opportunity to invest irrespective of the amount of money you have. So what we've tried to do is democratize investment and bring everybody in, essentially. So that's what we do. That's what I Invest does. And I think we've been pushing the platform and we've seen a lot of patronage and we're making good progress. So I'm happy to be here.
Fantastic. So today, coincidentally, I saw something on social media which said where somebody was saying that they invested in Microsoft stocks like 5 years ago, and just only recently she was able to sell the stocks, and the earnings or interest that she got from the stock was able to buy her a house. So she was excited. She went on Twitter and she was like, oh, thank you, Microsoft, stuff like that. So, and I've also seen people on the other side say, oh, I put my money here. In fact, I can't remember the stock I bought. They've not paid me anything and all of that. So can you talk to us about some of the benefits of buying stock, and you can even give us some examples before we even before we start going through some of the questions that I have here for you.
Okay, I think it's important to say that let's not have let's first clear the air. Equities are not necessarily time bombs or bad instruments. Okay, a lot of people come and once they hear stocks, equities, they shut down. They don't want to talk about it. They don't want to touch it. But I think we must first demystify that. Equities are very good. It's an asset class that is good and offers returns. However, you must just understand how to partake in the market. There has to be, it's not one in which you go in with a mob mentality. I think that's what caused the problem initially, where in the early days where people just say, oh, there's this stock and you just put your money, you did 20%, there's something going on there, oh yeah, let's all go. And then people went, and I think people entered at the time where the market turned. And since then, I think 2008, 2007, some people will never forget that period because a lot of people lost a lot of money. So I think first things first, we need to clear the air on that and say, come, equities is an asset class, and it is a good asset class if you know how to respond, if you know how to play that market. That being said, I think typically they'll tell you equities are long-term investments, okay? So if you're going to invest in equities, you should be thinking about it. It depends on what long-term means for you. For some people, long-term is 5 years. For some people, long-term is 10 years. For some, is 20 years. Those that can see far out, okay? Now, you give an example of someone who invested 5 years ago, and today the returns has given her opportunity to purchase it. That's the kind of supernormal return you can get if you get the stock right. I'm sure when she was buying it, it did not look like anything significant. It just looked like one other investment she's done. But that's the side of equities. Then we now need to speak about. I'm sure we'll speak about how to look at it from a place of, okay, which sectors will do well in the future. What are the factors? There has to be some rigorous work, and which is why people always say work with a professional to ensure that you are making the right decision. Because if you make the right decision, you will benefit significantly. If you make the wrong decision, you will lose your money. It's two extremes. So that's the way I'll say it.
Fantastic. Okay. So another question I have for you now is, what are the best methods or ways to follow while making investment diversification decisions in stock?
Okay. I think the first thing to say is this. I mean, for everyone to follow, and so that we make it a bit easier. Diversification is just you allocating your funds in such a way that you do not you avoid concentration. Okay, that means you allocate across different securities or across different instruments or across different names to ensure that you have a widespread, and in the event of any shock, you do not completely lose your money. I'll just use a simple example. If you have, let's say if you have 9 eggs, right? Let's say the eggs are different stocks, right? And you have 3 baskets, okay? The baskets can be, if you put all the 9 eggs in one basket and leaving out the 2 other baskets, if that basket falls, everything is going to break and everything is going to be destroyed. Now, if you flip it and if you put the eggs and divide it into 3 parts, so 3, 3, 3 into 3 baskets, even if one basket falls, 2 other baskets would remain, and that way you've preserved some value. So even if you have a loss on one side, on the other side, you preserve value and you probably increase value. So diversification just allows us to spread our risk, essentially. Now, what are the ways to do it? Now, there are a number of ways. I mean, just so that I go straight to the point and to make it very simple, okay? So because I don't want to use any technical term to use anybody. There are a number of ways to go about it. The simplest way, which people always use or think about, is looking at it from a fundamental perspective. Okay, there are a number of stocks. There are 1,000,001 stocks. I mean, in Nigeria, you have a number of stocks. Okay, you can then say, can we do a sector distribution? Okay, so you can look at financial sector, financial services, oil and gas, technology, agriculture, and then you go into those particular different sectors and then choose which particular names you want to do. Now, if you look at it that way you have spread your risk across different sectors. So even if the economy, anything happens in the economy, right? Let's say, for example, in that particular year, the economy does well from a telecoms perspective or from a technology perspective. That way, you realize that you win on that side. So even if you invested in oil and gas that is not necessarily doing well, what you make on telecoms or what you make on technology would support what you would cover for any loss you probably have made on the oil and gas side. So essentially, that's one way. Now you can then introduce some more complexity into it. So some people will say, people say I buy only large cap stocks. I don't buy small cap stocks. What are they trying to say? They're trying to say that they buy only stocks that have a lot of liquidity on the market. It means I don't buy penny stocks. I only buy stocks. And there's benefit to that as well. Okay, so you can look at it from that perspective. Another way to look at it is this: within the sectors. Okay, so we have financial services. Within financial services, we have banking, we have insurance. Okay, so you can then ask yourself, okay, I have financial services. I want to then spread my risk further. I don't want to do banking alone. I want to do some banking stocks. I want to do some insurance stocks. What are you trying to do? You're just trying to spread the risk across different sectors so that in the event that the market moves, in the event of economic cycles, your investments can still do well. So even if one does not do well, the other will do well. Now, there's also that rigor and nitty-gritty required in choosing a particular name. But we're not going into that so that we do not start investment 101 here. But overall, that ability to think broadly, okay, and see the different areas that you can choose from allows you to diversify. Also, one more thing. Another way to do it is this. Some people do historical returns or historical performance. Now, what does that do? It allows you to choose names that have done well in the past 3 or 5 years. So if you build that complexity into, you say, okay, I've chosen based on sectors, I've looked at sub-sectors, I've chosen large cap or small cap, then I've now introduced return as a variable. What you are doing is you're basically trying to sieve the market to allow you narrow. Even if you're spreading your risk, what you're doing is you're trying to narrow down to the best names you think you can have. But this requires a lot of work and a lot of thinking and a lot of rigor, which a lot of people don't like doing because it's money. You know what Nigerians like? What's the return? I'll make 10%. Just put your money there. It's less cumbersome. But with equities, you need to do this rigor to actually do well.
Fantastic. The next question I was actually going to ask you was about, how to manage risk and all of that. But from what you've said, maybe it's better for you to, spread your risk in terms of sectors and all of that, right? Are there other ways that you can also access, or ways that you can just ensure that you are managing your risk? Are there other ways, or you think that the best way is through diversifying through sectors?
Okay, so what I would say is this, right? That first things first, if we look at the entire portfolio management story, okay, let me put it that way. One of the things they would typically say is before you even construct a portfolio, you need to determine what your risk appetite is. Okay? So what is your risk appetite? What are you willing to? And the definition of your risk appetite is a function of your own unique circumstance. I cannot use my own risk appetite to do another person's. Now, what do I mean by unique circumstance? Just to give some context. One, what stage of life are you in? What are your aspirations? What sort of needs do you have in the near future? That will help you plan a bit better in terms of how you are structuring your portfolio and the kind of asset classes you want to invest in. Now, they will always tell you that younger people should invest in stocks because they are long-term and whatnot. Now, in terms of managing risk, right? Once you have defined your own risk appetite, one of the things they will also say to you is this, or one of the things that to think about is this: you can have an equity portfolio that can be divided into two. One can be long-term and the other can be short-term. So when you're managing the risk, okay, now if you have a long-term portfolio, imagine you've said, okay, I'm not going to touch this money until year 10 or after 15 years. Even if the stock goes down by 15%, it's not really your problem, because to be honest, you are looking at a 15-year return period. Okay, so even if the stock goes down 10%, 15%, you're agnostic to all of that. Now, the problem is a lot of people always just sit down and look, and once they see any small shock, there's that fear. Okay, now if we have that long-term perspective, okay, and you enter into a stock with that long-term perspective, one of the things about equity investment is discipline. It's the discipline of staying true to the strategy. Now, if you know that you are one of those people that, okay, fine, instead of doing, and my heart is always going up and down, when I see it down, I go and check. I know some people check it every night. Then the high blood pressure will go up and then come down. If you said it's a 10-year strategy, keep it as a 10-year strategy and that. Now, if you really want to play the market, you can divide your portfolio into two. One is short-term and the other is long-term. The short-term one is that I want to take advantage of the movements of the market. So you want to take advantage of price movements per time. It means that portfolio, if you are managing risk, it means that you need to have an exit strategy. And now that exit strategy means that you must determine the price at which you will say, okay, if it gets to this level, I am a willing seller. The problem usually is, more often than not, when it gets to that level, a lot of people say, it's still going, let's leave it. And they keep going. And the truth about it is not easy to catch. The hotel is not easy to catch the bottom, and it's not easy to catch the top. So the discipline is set a level, exit at that level. That's for your short-term portfolio. For your long-term portfolio, there are different things that will then determine what will make you exit. It may be, I have my son is going to school in 15 years' time. And at that point, I will exit. Now, don't forget, within that 15 years, if you bought a good stock that pays dividends and all of that, you would have been receiving dividends through that period. If the company is actually one that has vision and is going somewhere, in that period, valuation should have increased, prices should have gone up, and you would have earned some interesting capital gains and exit profitably. So at that time, even if they are telling, look at your friend that did Microsoft, whether they told her if the price went down 2% or went down 5%, it wasn't her problem. She invested 5 years ago. Between 5 years and now, the stock has probably gone up 40, 50, 60%. She's made money. The money enabled her to buy a house, and she's moved on. So that's an easier way to look at it. But again, some people have the heart to do the short-term game. The heart for the short-term game is discipline. If you know you want to exit at a price, exit at that price. If you then decide to play the game of, it's still going, It's at your own risk. And if you lose money that way, then, I mean, it's your responsibility, essentially.
So do you think it's better for you to speak to like a stockbroker before you make that decision if you don't really understand the stock markets?
To be honest, yes, I think so. I mean, for those who do not have adequate experience playing the market, it's usually good to speak to a professional. To be honest, if you do not speak to a professional, then you're going to be you may be flying blindly. Okay, what do professionals do? They will give you more information. Don't forget that buying and selling stocks, you are essentially trading information. You are trading information on the company. You are trading information about the company strategy, about the people, about their products. Is information we are trading. Because if something happens tomorrow, just imagine a tweet. Oh, this company did XYZ in returns, in profitability. Everybody likes the stock already. Let's go ahead. Okay, COVID happened. Okay, what's going to happen? How do people meet?
It's like there's something wrong with his internet. Oh wow. I'm not sure what's wrong with today's internet. Hi. Can you guys see me? Oh my god. Okay. I'm sure he's going to come back, but can you guys see me? Or can you hear me? Okay, I think you guys can. Okay. I'm sure he'll come back. Maybe something happened with his internet. But I'm loving the way the conversation is going. It's important for us to have this information. Like, I feel like the things that will set a lot of people apart are things like this, information like this. Like in 10 years' time, people who have invested in like good stock, saved a lot, things like that would set you apart. So I'm excited that we can we can get this information. Someone even sent me a message earlier today saying that he did an investment, and in 2 months he was able to get $3,000. So trust me, that was just free money that he probably wouldn't have had if he didn't take that decision. Imagine if he waited longer. So I think that's an example of someone who had the short-term plan as opposed to someone who had the long-term plan. So I think diversifying your portfolio actually works, but obviously for people like me, I think I may need to probably speak to like a stockbroker or somebody who can help me make the right decision, because sometimes it can get scary when you see something dipping. Even anything can happen, and nobody knew Corona was going to happen. Nobody knew any of those things were going to happen this year, and it happened. A lot of things dips, but once you have somebody telling you or setting your mind and saying, "Don't worry, it's still going to go down," or it's still going to come back up, then your mind will be at rest. So, okay, I don't know what's happening with I Invest. They tried to come in now, but they couldn't. I'm sure they'll try again. Maybe there's something wrong with their internet. Thank you, Gallant Grace. It's premium information, and you guys are getting it for free. Just tell me in 10 years' time, once you guys have gotten your returns, that's when I want to see you. Just send me one nice Ferrari so that I know that you're really thankful. Oh my goodness. I hope they can come back very soon. I still have a lot of questions. Yeah, maybe it's the rain actually, but I'm sure they'll come back soon. There's probably something wrong with their internet. But you guys can ask me questions in the meantime, any questions you have, and I'm happy to answer you just before they come back. Someone is saying, even with the stockbroker, return is not guaranteed. Of course, nothing is guaranteed in life. It's like anything. Like today, I needed to change dollars, and this morning, dollar was 460. By this evening, the Aboki was saying it was 457. I said, you must be joking. Like, just give me the money that we had already agreed for, So I know that nothing is guaranteed, obviously, but, just try to like get professional help so that at least you're sure that your decision is almost good. And if something else happens, obviously, maybe from diversifying your portfolio, you're not going to lose all your money, and you gain, in some other way. Village people don't want you guys to make money, not from AGS, so don't worry. AGS, our own is sure. So, okay. someone has a question for him. Please put all your questions in the little box there, the question mark, so that at the end, I can just easily click on it instead of me scrolling through all the comments. Okay, so he's back. Fantastic. Thank you. The network doesn't want us to be based, but we refuse. Okay. Okay. So another question I have for you, or did you finish your last question?
Sort of, yeah.
Sort of, I did. Yeah, sort of. Okay. So another question I have for you now is, how best can an investment portfolio be impacted by inflation? How best can you manage inflation when it comes to investment? Is it that maybe you should just play the long game, or how does it work?
So I mean, first things first. I think the relationship between investment returns and inflation. Okay. Typically they will say that if inflation is higher than the return you are getting, it means you are essentially getting negative returns. What does that mean? It means that the prices of goods and services are growing faster than your money is growing, in layman terms. So if, for example, I mean, today inflation is 13%, 13.2, okay? And you have a portfolio that is doing 10% or 9%. Let's even be practical. Treasury bills are at 1.1%, 2%, and 3%, okay? So you look at it and then you realize that the difference between 13 and that is huge. It means that in real terms, if you are saving money in those instruments, you are getting a negative return because prices are moving faster than the return you are earning. Now, in designing your portfolio, you have to, that's a consideration to have, because you want to get at all times positive real returns. That's what you always want to have. And positive real returns means that you want your return to be higher than inflation. Okay. Now we can go into the other factors that drive inflation and whatnot. I mean, of course, there are things that we all need to look out for out there. FX is a factor. You're talking about your booking and things. FX is a factor. If FX is more expensive, it is scarce, food will be scarce, and all of that. If oil and gas, if petrol prices are going up, everything is going to get more expensive. Now, there are ways to then look at, so that's where that fundamental analysis has to come in. I mean, it sounds huge, fundamental, but it's just looking at the sectors to say, okay, which sectors are actually suffering, or which sectors are going to benefit from this? Because if oil prices are going up, there's a reason why it's going up. That means some people are going to benefit from higher prices, whether you like it or not. So how do I align myself, or how do I align my investments in such a way that I am on the side that benefits from all of this movement? Because everything going on is about movement in prices, and we're just shifting the world from one place to another at a time. So for example, now we all see data is like oil. If you don't have data, you can't work, because I mean, most of us are working from home. You can't do anything. You can't work. So it looks as if the guys who provide, the telecom guys who provide data now, they're like kings, because we are all spending that money and it's now compulsory. So you ask yourself, even if price of petrol is going up, or they say electricity price is going up, is it the guy you're buying data from? He's making more money, because you have to still buy that data to work. Then how do you align your investment decisions to flow with such thoughts? Those are some of the things and the truth is, see, sometimes it looks simple, or it looks like it's not that straightforward, but over time, what we find is that those investment decisions align to fundamentals. There are technical factors. Maybe one big seller comes and just sells down the stock, and the stock all of a sudden looks cheap. But over time, over a 5-year period, over a 7-year period, we're in a new normal now. So Zoom and all those guys, truth is, we're still going to keep using them for the foreseeable future. Except something new comes that takes them out completely. And when that thing is coming, of course, another factor is this, and this one is a bit more difficult, but one of the things they say is ability to predict cultural changes. Because once culture changes, spending pattern changes. When spending pattern changes, money is flowing to a certain place. If money is flowing there, how do you want to benefit from that flow? That's all. So inflation will keep moving up and down. But the question is, where is the money really going, and how do I benefit from that? In a simple way, that's the question to ask and answer.
So, for example, now healthcare is a good sector to invest in, especially because of COVID and everything that's happening right now. Fantastic.
So,
okay.
So the question one should be asking is, how do I access healthcare? Hospitals don't have, they're not on this. I mean, some hospitals are on the stock market in some other countries. In a country like Nigeria, so maybe the question is pharmaceuticals. It means people are buying more vitamin C. Trust me, everybody's buying vitamin C because everybody wants to have immunity. So how are the pharmaceuticals benefiting from this, and how do I jump onto those stocks? So that's an area you've also mentioned that is good.
Fantastic. Okay, so do you think that exit strategies are necessary in portfolio diversification?
Again, I'll answer it this way. Your investment motive and your return objective, as well as other factors, will determine your exit strategy. If you are playing the long game, okay? If you are playing the long game, what is motivating you? There's something motivating you to invest in that stock. If you want to play 10, 15-year game, and usually people, maybe you have a young family and you're thinking, oh, I want my son to go to Harvard, okay? And the only way for me to achieve that is I must buy stocks, and I'll buy some local stocks, or I'll buy some foreign stocks as well because I want to hedge, okay? Now, at the end of the day, year 15 comes, you've made money on the stock. Let's assume you made the right decisions and you didn't make a decision of buying a stock that went down after 3 years. On that, at year 15, the exit strategy is very clear. It's time for him to go to school. You go, sell the stock, carry the money, and pay. Now, if you have a short-term strategy, then there are many other factors to look at. That means you're doing technical analysis and playing that in the short game. Essentially, at that point, you're asking yourself, what is the compelling reason to come out of this stock? Some people buy stocks for dividend, just for the dividends. They want to get continuous cash flow. So they go and buy stocks that pay dividends regularly. Now, until that company's dividend policy changes, they may decide to stay in that stock because it's an income earning game for them. For some others, it may be a case of, you know what, I heard that, or I've looked at their strategy, and it looks like the strategy is going to work within the next 3 years. So I'm going to align myself until that strategy changes, or the principal actor driving the strategy changes. Maybe that's what will compel it. For some people, it's purely return. I want to earn a 15% return. Is at 14%. I don't think it will go higher. I'm out of the stock. Let me also say the other way. Sometimes there's the downside, and I think it's important for me to say this. Sometimes you may say, my strategy is this, plus 20%, minus 30%. Okay, it hasn't gone up, it's minus 10%, I'm still in it. Minus 20%. Now, some people would then say, no, let me average down. You see, that average down story is very delicate. But it then brings you into, so that one is a decision saying, I believe this stock is going to go down or it's going to go back up. It's the economy. Now you may read it right. You average down and it goes back up and you do well. For some others, you will average down out of, this is called the trader sentiment. That sentiment of, no, I got this right, this decision. I was very sure. And you average down. Oh boy, you average down and it's keep going further down. So they always say the discipline is clear. If you plan to do plus 20%, it gets there, exit. If you planned and you said, oh, minus 20%, that's my loss limit. Anything after minus 20, and I'm not doing it again. Also keep that discipline, except you have superior information that will allow you to say, no, I will still wait in it because I believe this is all circumstantial or momentary.
Fantastic. Okay, another question I have for you is, what is the minimal amount in Naira somebody interested in asset diversification can invest in and get good returns?
Okay, before I get to that, somebody asked a question, what is average down? What I'm saying is this, okay, you have 1 million units of the stock. The stock has gone down 15%, okay? Now, you then say, you know what, I still believe this stock is a good stock, so you go and buy additional 1 million. Now, let's say you bought 1 million at 2 Naira. The stock has gone to 1 Naira 50 kobo. If you buy additional, what you are trying, if you do an average of that, your price then comes to 1 Naira 75 kobo or something like that.
Yeah.
Essentially, if that stock goes back up, what it means is that if the price stock goes back up to maybe 2 Naira 50 kobo, your buy price is now 1 Naira 75 kobo, and then you can sell at 2 Naira 50 kobo. So that's the essence of averaging that. You're just buying additional at a cheaper price to reduce your weighted average price. So I think that's just to answer that question. I think you asked the question just to, I think
the question was about what's the minimum amounts that you can literally spend on the stock. Yeah.
I think I usually like to say to people, see, it's usually if you say, oh, 1 million naira, person say it's too far or it's too small. Everything is relative. Start from where you are. I mean, I know someone who says, see, I want to buy foreign stocks, right? And I have just 500K or 1 million. I converted the money to dollars. When he was buying, he said, I only bought 2 units of Disney shares or 5 units because the prices, I mean, those guys are trading at serious premiums, maybe $200 per share and all of that kind of. And he said, he only bought 2 units of this, 3 units of this. And I said, see, come, go for it. Start from somewhere. Because the truth about it is, if you do not learn it at a small scale, you cannot understand it at a larger scale. You will lose more money. So it's usually better to start from where you are. If you have 50K in this market today, you can buy stocks. Go on and invest. Key in the details. You will buy. Whatever you need 50K buy it. Start from there. Even if it's a long-term game you want to play, it's simple. Go on and invest. Download the app, register, and on your wallet, and go ahead and take 2 names and test it. I mean, on iInvest, we see people testing with 15,000 naira, 10,000 naira, and I understand it. That see, I'm just testing this process, and I'm testing if this thing works. Now, after 1 month or 2 months, oh, you may not go your way, or you may have it. Okay, you know what? I just want to be keeping it in stocks. And I think the best way to create a portfolio usually is sometimes, a lot of times, and particularly in this part of the world, we stumble on it. It's not deliberate. We're not usually very deliberate about saying, okay, I'm going to hold 10% of my money in stocks, 15% of my money in treasury bills, 30% of my money in bonds. We're not very much like that. But the discipline and principle of portfolio management makes it important for us to do that. However, we don't have, with money, we're not usually like that. So what I would first say is this: we need to first have that discipline and culture. You must know what percentage of your money that you're setting aside you want to keep either in cash or either in a security. A lot of us have cash in the bank just doing nothing. Say, I prefer my money to sit there. But the money is not working for you. Even if it is earning, and they'll tell you now, they'll pay you 1%. Give yourself the chance. So the chance is this: sit down, create a portfolio. Okay, oh, you know what? I have my money. Now, FX, let me just say, dollar is now an asset class for people in Nigeria. Just holding dollars for them is like, I have pieces. Now an asset class, which is okay. It's a way to hedge your portfolio. Now, think about it. You can then say, okay, you know what? I have this cash. I have 1 million naira doing nothing. If you say, for every time I earn, I'll just put 50,000 naira or 20,000 naira or 30,000 naira in a particular stock, a stock that you know that, okay, they will always pay dividend, and you do it gradually that way, you realize that over time, you would have put a significant amount of money in stocks. You will have a significant amount of money in foreign currency as you wish. And you probably say, okay, no, I can buy T-bills and bonds. Now, when you step back after 3 years or 2 years, you realize that you have a portfolio. You become your own portfolio manager. Now, sometimes it's also good to work with professionals because they are able to give you this direct advice. Say, no, buy 30, put 30% in this. Now, it depends on how old you are too. For young people, I mean, they'll say if you're under the age of 40, you should be buying stocks. Your friend bought Microsoft. And I think that was a good way to start the conversation. Bought Microsoft 5 years ago, today they're smiling to the bank. The question we should be asking is, what should we be buying today that will smile to the bank in 5 years' time or in 10 years' time? How do we predict the cultural changes that will happen that will allow us to know that we should be investing in this sector? People who invested in pharmaceuticals 5 years ago, 7 years ago did not know. They were just doing it as, okay, no, let me diversify. We never know. Today, if you invested in pharmaceuticals, you invested in technology, you are chilling. Because it's almost as if you saw the future. But nobody has a crystal ball, which is why they will also always say, spread your risk, put it in different places. There will always be some analysis to say, at some point, exit this guy and come into this guy because this is maybe the next wave, or this may be the next move. So for me, in terms of how much, start from where you are. That's 10K in your hand, that 15K, that 20K makes a big difference. And for the guy who has a lot of money, okay, you have 20 million, 30 million, 50 million, 100 million, start from there and then do it gradually. Now, for those who are older, I will always say, I mean, you are older, there's no point playing in the stock market, to be honest. I think it's at that point you're talking about capital preservation. Okay, that's not the time to build an aggressive portfolio. You should be preserving your capital, preparing for retirement, and just saying, okay, let me just wind down and rest and enjoy my money. But young, this is the time. let's go into the stock market. But let's go into it tactically, basically.
Fantastic. Thank you so much for that. So now I'm going to go into questions from the audience. So I'll just start putting it in so that you can just see it. So someone is saying, I'm 21 with little or no financial education. How and where should I start? High risk, high reward.
Okay, so think about it like this, right? You're 21. Even if you lost all the money you have today, you wake up tomorrow morning and continue life. You don't have responsibilities. You have, I mean, let me assume, okay? So they will always say, this is, the younger you are, that's the time to take risk. It's the best time to take risk. At this point, some people will say, what's your definition of older? What's your definition of younger? To be honest, people will say under 40, some say under 30. It depends on you. Now, some people are under 30 and they already have a lot on their plates. That's fine. However, it depends on a number of things. Like I said, your unique circumstance. What are your return objectives? What are your projections in terms of your aspirations? Okay. And where do you see yourself in 10 years? Where do you want to be? Because it is you essentially laying your bed. So, okay, you know what? I want to have X amount in investments. I want to have X amount in stocks. I want to have X number of properties. I want to have X amount in bonds, in euro bonds, and then I want to have X amount in cash. Now, if you've done those projections based on your income and based on things you think you would do to generate income for yourself, then that planning process. So a lot of times it's always good to work with the professionals to plan. If you don't know how to do it, I mean, the financial professionals may be able to do it for themselves, but those who don't have an idea, okay? So the key building blocks is number one. At that age, you are young, 21, okay? I think at that point, you can take a lot of risk. And a lot of risk exists here in the stock market. Give yourself a 10-year horizon. And I think one of the things people don't realize is consistent, disciplined savings, either in equities, fixed income, is very beneficial over time. What that means is that if you are saving consistently, if we do the math here, it's amazing. 10,000 naira, you do 10,000 naira every month, okay? Let's even say from 10,000 naira monthly, at the end of the year, you have 120K. And then if you do that consistently for 10 years, I've even discounted the fact that your income will grow, your all of those things. So disciplined, consistent approach. I know someone that says every month, once they pay salaries, she removes a certain amount, fixed amount, and buys equities. Fixed amount, 50,000 naira, and buys equities every month. Now that's 50,000 naira you can use on Friday night. Giving, exactly. Or 50,000 naira we can use to go out on a Saturday afternoon for brunch. So that disciplined approach at that age, over a 10-year period, if you do the maths, it's amazing how much you'd have saved. So I think for the 21-year-old, high risk, get into the stock market and be aggressive. But of course, seek professional advice on the specific names that you want to expose yourself to.
Okay, so how can the iInvest app even help us?
Very simple. I think the iInvest app it's a very simple application. And one of the things it does is it allows you invest for as low as 50,000 naira. So download the app. All right. Now the app would ensure that you register. Okay. It's always good to register immediately you download so that everything is set up. Okay. But it doesn't stop you from investing if you do not register. After registering, of course, then it will require you to fund your wallets. So you fund your wallet with the cash. Now you can fund your wallet. Once you do a transfer, it automatically tops up your wallet, the account numbers where you can transfer to, or you can use your card. And if you use your card, we debit your card directly. And then once that is funded and that happens, the next thing is this: you can then go on the app, open up the app, and then start looking at different options. Particularly in stocks, you have an array of stocks you can buy. And then if you already know what you want to do, just go to the app, click on the stock you want to buy, debit your account, your wallet, and then the stocks are credited to your account. Very simple. And that same process happens.
So does the app even advise you to say maybe something like stock of the day, something like that, just for people who are new into the investment world? Does it do anything like that?
So one of the things we are also working on, okay, is to ensure that we're able to give those sort of, I mean, it's not, we're not going to advise anybody to say buy this, because if I tell someone to say buy this, if it doesn't work tomorrow, the person will say, is that invest that I should buy? So we ensure that people are able to make independent decisions, okay? What we know, what we are sure we'll do is we'll give you good execution, excellent execution. The execution people pay for at more exorbitant prices out there, we will give it to you, even with your 50,000 naira. That's one thing we are sure. But in terms of guaranteeing a certain stock as, oh, this is a stock that will do well for the future, one of the things we always say is this: you will have to make that independent decision. And like you said, to be honest, nobody's good. I mean, there's no portfolio manager out there that's going to guarantee you any returns anyway. The most important thing is they will only advise in terms of these are the areas you can focus on and these are the areas that you can invest in.
Okay. Someone else is asking, what if I invest goes bust? How is our investment protected?
Okay. So the Invest platform, I mean, as it is today, is we ensure one thing, that security of our application is at the core of what we want to do. We don't only want to give you access. We want to give you access in a secured fashion. Okay. Now, one of the things we do is we have some security features around it in terms of the way you bring in money and the way you take out money. One of the key features we ask for is your unique identification number, which is your BVN. That BVN, I mean, that's unique to you. There's no two people that have the same BVN. So nobody can take money out of that account. Nobody can, except that BVN is a key factor. And if we do not confirm that BVN story, the monies cannot leave. So that gives that level of protection in terms of we are connected and we ensure that we validate those coordinates before people are able to take money out of the account. In terms of execution, one of the things we also say is this: we give you direct access to the markets. Okay, so we're not trying to be. We give you direct access to the market, and as we give you direct access to the market, you're able to execute. You're able to execute real time. Now, all the stocks that you purchase, okay, are held with CSCS. All right, CSCS is the central clearing system for all equities in Nigeria. Now, we're not going to hold your stocks in our position. So as that gives independence. Okay, so that independence means that you buy the stock today, the stock goes to CSCS. You can go and confirm your stocks with CSCS. Okay, now for T-bills, for treasury bills and bonds, right? Those are held with what we'll call a licensed custodian. Okay, now all of these are just to ensure that there is independence and there is that security, and it gives you more comfort, so you can independently check if what you have purchased exists in safekeeping, so that it doesn't look like you're buying a scam, that we just bought something and it's not there. Yeah.
So in other words, what you're saying is, even if, God forbid, the iInvest app stops working or the iInvest goes down, you still have your stock, safe with the, clearing. Sorry. That's
so then, yes, but I wanted to say something. I wanted to say do iInvest will not go down. But what it means is this: that there is but it is. What it means is that there is independence. Okay, that independence means that irrespective of what happens, we are not. You've just used us as an execution platform. The stocks are held with CSCS. The bonds and the Euro bonds and the treasury bills are held with the custodian. That independence ensures that we have that segregation of responsibility, and that's the standard anywhere. Even for our pension funds and all of those things, that's the standard required, and we have also adopted that standard as well.
Fantastic. Okay, someone else is asking if they can invest in foreign stocks on the iInvest platform. Shortly,
you'll be able to. It's something we're eager to do, and it's something that is at our priority list. So in the very near future, you will see we'll give you access. I mean, about 6 months ago, you couldn't do stocks. Now you can do stocks. So very shortly, you'll be able to invest in the in foreign stocks.
Okay, so someone is asking, the rate of inflation of the Naira box is really discouraging. How do I go about investing in international markets so I can earn returns in Forex?
Okay, I mean, on our platform today, there's a section that caters for Eurobonds, right? So Eurobonds are instruments that are dollar denominated, okay? And you will be able to earn return in dollars. Okay, so if you buy the Eurobonds on our platform, you will earn coupons. That's coupons referred to the interest now. You earn coupons in dollars, and that allows you to enjoy dollar returns. So how does it work? You fund your wallet. So on the iInvest app, you have your Naira wallet and you have your dollar wallet. So you fund your dollar wallet with your dollars, all right? And then what you are then able to do is invest in those Euro bonds using the dollars in your wallet. And then on an ongoing basis, once they pay the coupons, your wallet will be credited directly, and you will continue to enjoy those dollar returns. So yes, the iInvest app gives you that opportunity, and it gives you that access as well.
Fantastic. So someone is asking, hi, thank you for this. Please, what pharmaceutical stocks would you advise us to buy?
I mean, there's a disclaimer on, I mean, I'm not going to say go and buy this stuff or go and buy that stuff, but I'm just going to give you general advice, right? And my general advice would be that, see, it's very simple. You need to look at those guys. I mean, the pharmaceuticals in Nigeria, there are a number of names. So which of the names will you find on the stock market? And do a simple, I remember my life as an equity trader or an equity analyst, so to say. Sometimes it's as simple as, okay, if I'm analyzing a particular brewery, let me use the breweries because the breweries are usually very interesting. You ask yourself, what are people drinking on Friday night? It's very simple. Which one are they drinking more? Are they drinking the black bottle or the green bottle? So I don't call any names, I'm just trying to, are they drinking black bottle or the green bottle? And to be honest, a lot of times we find that doing those little checks, okay, and then we now compare to their numbers. Okay, at the end of the quarter, what have they sold? You realize that we saw more green bottles, and truly, the green bottle people are doing better than the black bottle people, or the black bottle guys are doing better. It's very simple. So go out there and ask yourself, who are those names that are on the, now we all go to, everybody has gone to pharmacy within the last 3 months, everybody, for one thing or the other. So if you look at those, who are those guys that are selling out on certain things, all right? And then you start asking those questions. Now call your analyst or your investor or whatnot, and ask those questions that I think I've seen X, Y, Z. What do you think about them? Now, pharmaceuticals in Nigeria, we have a number of names. Okay, I'm not going to mention any specific name so that I do not because. But the due diligence is this: look at what is out there and look at their numbers. Historical numbers are not necessarily a measure of what future performance should be, but they just give you an indication. If these guys have been doing X, Y, or X and been growing at X%, in these times where there's a particular push now where it looks as if they should be benefiting more, maybe they will have supernormal growth. Now, if you have a guy who has not been really doing well in the past, and he does not have a product out there that is going to help him do better, there's no need buying the stock. It's not good. There's no magic. However, if you have a guy who has been okay, doing well, I mean, they've been growing, it's single or double digits, and they've been growing gradually, and then you believe, and they have a product out there that looks like he's doing well, okay, then you ask yourself that this guy is going to do better than he's doing because now his turnover is going to increase, because before we're consuming at maybe 1 month cycle, now we're consuming every 2 weeks. I'm sure there are some drugs we go out there to buy and they'll ask you, they'll tell you we don't have, come back in 2 weeks time. That happens. I've been to a pharmacy and they'll tell you it's not available. So those are the kind of guys you're going to be looking out for and saying, you know what, I need to get into this name. But it's a sector to look out for.
Fantastic. So next question, someone is asking, have you experienced any fraud on the platform?
No. So far, our experience has been one where all the things have gone properly. I mean, you can ask any of our clients, and we have had an excellent. We've had some level of, we can't say, I won't say it's luck, but we've also prepared ourselves in terms of checking the things that will ensure that we protect all our clients, because for us, safety is at the core of this entire process. It's not enough to say you do execution properly. It's not enough to say we'll offer you good returns. And I think for this, on this part of the world, I think what people are concerned more about is my stuff safe? I really don't, if I'm going to earn, they will rather do investment on a safe platform that they will earn slightly less than doing an investment somewhere they will get and then it's not safe. So yes, we've had an excellent experience so far on that.
Okay, someone is saying, I recently lost $100,000 to FX traders or scammers. What do we ask from people to confirm their realness?
Okay, now that's a different area. Okay, now I'll say it like this: the equities market and equities and securities markets are a lot more regulated. Okay, they're a lot more regulated. Now, FX, the foreign exchange area, that's a market that is regulated, but it depends on the level at which you are playing. If you are playing with the abokis and whatnot, or the random forex trader, that guy is not essentially very regulated. So what the thing to look out for is, number one, what regulatory supervision guides the area in which you want to play, because that is very important. If there is a guy who, for any reason, you invested, okay, and then for some reason the money has just flown with the wind, you can go online, send an email to SEC and tell them this is what happened. That's for a regulated entity. Now, if it's not a regulated entity, there's nothing that, I mean, that's why people always say, what kind of entity are you dealing with? What sort of platform are they regulated? Who are they? And then do the general due diligence. Who are those promoting the company? Who are those on their board? Who are those? Those are factors we need to check. Yes, I know we have become a bit more comfortable because I think things have sort of improved, but I think those minimal checks are still very, very important. And I think everybody should do their due diligence before going into such investments.
Fantastic. Someone else is asking, how can someone without any experience on investment start?
Okay. Now, I think today we're talking about stocks, but if it's specific to, I'll say, let me talk generally before I go to stocks. If it's specific to investments generally, I think there are very simple instruments that are out there that everybody already knows. Treasury bills are very simple. You know what you are going to, if you put your money over a certain period, even you can do the calculation. This is how much I expect. Now, they are called fixed income instruments, means that their income is predictable as long as you are earning the interest over the life of the instrument. So on our platform today, we have treasury bills. We even have fixed deposits. It means that you can deposit the money there, and then you know that after 30 days, I will earn X interest. That's simple. It's not complex. It's very straightforward. You can start from there. Now, when you then say, okay, fine, I understand this. It's clear to me. Then you can now start moving your way up the ladder, the complexity ladder. Say, okay, fine, you know what? I've done that. Then let me go up a little more. You can then say, okay, let me try this equity market. What are they even saying there? And usually the way to start stocks is this. They will tell you. There are some names that you know out there. You don't need the soothsayer to tell you. If I call those names now in financial services, it's a good one now. You know the name. If I call 3 banks, if I call Access, GT, all those banks, you know them. They are obvious names to you. Okay, that's an easy sell, and they'll tell you, oh, they'll pay you dividends over a certain period. So that's easy to understand. It becomes more complex when you are doing some more some other names that are not necessarily very popular, or maybe low cap stocks, penny stocks that has value but is not obvious. It's only the guy out there who will tell you no, I think, or the professional who can tell you there's something going on there that you need to look at, because they've done the analysis, they've done the checks, and they've done all the necessary due diligence on that name. So I think it's always best to go from simplicity and work your way up the complexity level.
Fantastic. Someone else is asking that, is iInvest similar to Trove, Bamboo, or Chaka?
iInvest enjoys a unique place. That's how I'm going to answer the question.
Yeah, fantastic.
I think we enjoy a unique place because for us, we believe in diversifying our offerings. Okay, so I mean, we're going into today. We started with treasury bills, then we included Eurobonds, then we included equities. Then now we are including, we're now thinking about insurance products. Okay, we're going into those areas as well. And there are many more products we're coming into the market with. Now we've included fixed deposits. There are other things we are working on that are going to come very quickly. Okay, so for me, I would say that we enjoy a unique place. Okay, yes, you can liken us to other people, but from our own perspective, we enjoy a unique place, and we are probably one of the few ones that are regulated amongst all of them, because we are under the regulatory supervision. Okay, so and that for us is important, because that should give a greater level of comfort to know that we are not just people out there who will just, like you say, someone lost money somewhere that was not regulated. You will not lose your money, because we are a regulated firm, and we believe in doing things by the books.
So someone is asking, in the case of death, can your spouses access your investment via your platform, and how would that be done?
So, I mean, there are a number of documents, which is why registration is important. Let me just hit it that way. But when you're registering, we have a number of questions we're asking. And there is a process for claiming in the event that happens. All right. So for us, what we ensure is that registration, which is why we tell people, even if you've invested, you will always get our emails to register. Because when we are asking for all those details, your next of kin and all of those sort of things, it becomes very important in circumstances that we need to use it. For example, in the case you have mentioned. So people should not take the registrations for granted. Yes, we would allow you to do that in terms of you invest, but in registration, there are questions we're asking, particularly around the next of kin, like I mentioned. That becomes important, and that will follow the process that is required for ensuring that the survivor, the spouse, gets the required funds.
Okay, I'm going to take one more question, and we have just 1 minute, so you have to answer that question in 30 minutes so that we can end. And I'm super excited that this has been super, super interactive. So the last question I'm going to take is, are dividends paid on the platform, or do we have to apply through the registrars?
So, I mean, everybody does e-dividend these days. So, I mean, that's already very straightforward. Okay, so e-dividend is the order of the day, and you will get your dividends. I mean, nobody's gonna take a dividend and put in their pocket. You're not going to be doing. I mean, everybody's trying to get away from manual processes. So I think that's sort of so.
Fantastic. Thank you so much. I don't want the phone to cut off before we finalize, but I'm excited. I think a lot of people have learned a lot from this session.
I believe so.
Have questions? I'm sure you have more questions to the iInvest DM. It's important for you to download the app. I'm sure by the time you play with the app once or twice, you would understand how things work and everything. Just play with it, download it. It's available on iOS and Google Store. You can just play with it and just start looking at the stocks that are good. You can ask people, ask your friends. You can speak to a stockbroker. Just spread your wings and don't be scared to invest. You can invest with as little as any amount you have. Just start the process and it will get better. So do you have any final words before the phone cuts off?
Download the app and get started. I mean, take action. I mean, that's what we always say. There's no better time to start investing than now. So get at it.
Thank you so much. Thank you for honoring our invitation. We've learned a whole lot. Thanks to everyone who stayed. Oh my goodness, like 171 people stayed till the end. I'm super, super honored. Thank you for taking it seriously. Hopefully, by the time we start investing in 5 or 10 years' time, we will also buy our Ferrari or anything we want. We'll send our kids to Harvard. We'll do all the nice things that we're dreaming to have. Don't just save your money in your bank account. I used to be like that, and we did not earn any. I did not get anything in return. It makes absolutely no sense. Invest in stocks. Just diversify your portfolio. It is super, super important. Thank you all so much for staying with us till the end. And definitely, I'm going to save this so you can share it. You can send it to your friends, family, people who need more information about how to invest. Definitely download the app. Ife loves the app. I love the app, definitely. So download the app, and I definitely recommend the app. Thank you. Thanks to all our tribe members for staying here and just be with us. All right, guys.
iInvest, your partner on the journey to financial freedom.